Major moves across politics, consumer spending, and commodities markets today. The US-Mexico-Canada trade deal may be under threat, McDonald's is seeing stronger sales than expected, and silver prices are whipsawing. In this video, we break down what's happening and why you should care. According to new reporting, President Donald Trump is privately considering withdrawing the United States from the USMCA trade agreement, the revised version of NAFTA that binds the US, Canada, and Mexico in one of the world's largest free trade zones. The scenario has been floated internally as Trump and advisors grapple with political and economic pressures ahead of the upcoming election cycle. Here's why this matters. USMCA facilitates roughly $1.5 trillion in annual trade between the three countries, covering everything from autos and agriculture to energy and manufacturing. Exiting could trigger tariffs and supply chain disruptions, especially for industries that depend on cross-border production networks. Think auto parts assembly that spans all three nations. The idea reportedly stems from a broader pattern of Trump pushing a more unilateral trade posture, favoring bilateral agreements or tariff leverage rather than multilateral frameworks. While Trump has also discussed renegotiation, actually quitting the deal would be a dramatic shift with likely implications for global markets and investor confidence. For Americans, especially in manufacturing and agriculture, this is worth watching. Potential policy changes could affect jobs, pricing, and export competitiveness. Switching gears to consumer spending, McDonald's is expected to report solid U.S. same-store sales growth fueled in part by its value-oriented promotions and broader price optimization strategies. Here's what analysts are watching. Value promotions, deals like discount combos and limited-time offers appear to be driving traffic at McDonald's restaurants across the country. Consumer behavior in a tight economy, with persistent cost pressures on households, affordable dining options like McDonald's become relatively more attractive, boosting both foot traffic and overall sales trends. Investors see this as a bellwether for discretionary spending. When consumers tighten budgets at casual or premium dining levels, they often shift to value brands, making McDonald's a proxy for broader retail sentiment. At the same time, restaurants face inflationary costs for labor and ingredients. McDonald's ability to balance value pricing with margin protection will be a key story in its upcoming earnings report. Finally, in the commodity space, silver prices have been extremely volatile, swinging sharply as markets grapple with narrow liquidity and shifting macro signals. Here's what's driving the swings. Thin liquidity, fewer active traders, and lighter positioning can cause exaggerated price moves on relatively small flows. Macro uncertainty, with oscillating inflation expectations, interest rate speculation, and safe haven demand, silver can suddenly spike or plunge in short periods. Unlike gold, silver draws both industrial demand from electronics, solar panels, and autos, and store of value interest. When markets perceive tightening credit or risk spikes, silver often spikes, but in thin markets, that reaction can overshoot either way. For traders and investors, this environment suggests two takeaways. Expect higher volatility in commodities with low liquidity. Use caution with leverage positions as sudden moves can trigger stop losses unexpectedly. So whether it's geopolitics, consumer spending, or silver prices, markets are reacting to policy signals, shifts in consumer behavior, and technical liquidity conditions. Keeping an eye on all three gives a broader picture of where the economy and financial markets might head next. If you found this breakdown helpful, hit subscribe for more real-time market analysis and drop a comment on which of these trends you think will have the biggest impact this year.